Good afternoon, everyone, and welcome to today's Qatar Centre virtual seminar. It's my great pleasure to welcome Mike Kiley from the Federal Reserve Board to give today's talk. I've known Mike for a number of years. He's one of the best minds in central banking today, so it's a great privilege that he's going to share his insights with us. Before I give Mike the floor, a word of housekeeping. So if you have questions while the presentation is going on, please post them in the Q&A box at the bottom of your screens. We will try and leave some time at the end as well for you to kind of raise your virtual hands and ask questions directly to Mike. So there's two opportunities for you. But without further ado, let me give the floor to Mike and look forward to your talk.
Thank you, David. I'm very happy to be here to present my work. It's a great opportunity in this virtual environment, and I hope everyone on the webinar is well, and please stay safe. Today I'm going to be talking about financial conditions and economic activity, insights from machine learning. Before I start, let me start with the disclaimer at the bottom of the slide, right? And this analysis is my own and does not reflect the views of the Federal Reserve Board or its staff. I'm going to jump into the motivation for the talk in a minute, but before I do so, I want to start with a warning. It's a warning both about the perils of machine learning, but also about what exactly I am attempting to do in using a machine learning algorithm. So here's a cartoon that some may have seen before. That talks about how machine learning is a set of algorithms designed for a certain goal, and really the output of the machine learning algorithm does not necessarily need to make sense to the analyst, right? They're really only interested in the output. Is it a good algorithm for, most often, prediction? As a result, the constituent parts, or how that prediction adds up, may not always make sense to the researcher, and that, of course, is a criticism of machine learning in an economics content where we're often interested, for example, in causal mechanisms. Today, I'm not going to be focusing on causal mechanisms, and I will be using a prediction algorithm. But as you'll see, I'm not actually interested in the quality of the predictions per se, but rather about the types of predictors that are selected by the algorithm and what they might tell us about how to use large data sets or about certain economic relationships. And so while I'm using a prediction algorithm, as you'll see, I really am interested in the constituent parts, and that in the end, they make sense. And that really is different from some machine learning approaches. Okay, so with that, let me start with the motivation. Now, I'm going to be focusing on construction of a financial conditions index, and that's an area in which research has proliferated in recent years. Now, while financial condition indexes have been around for many decades, their construction and use has really grown substantially, especially in the policymaking context. And of course, I sit in a policy institution. And many of the references here on this slide are from colleagues in the Federal Reserve or at the IMF, BIS, or at financial institutions. It's not uncommon for Wall Street firms to be producing financial conditions indexes. And so, for example, the papers by Hatzitz and Stein and by Barsh are examples of financial conditions indexes from Goldman Sachs and from BlackRock. The proliferation in policy institutions and Wall Street firms reflects the fact that, it's not uncommon for these indexes to be used, in two ways, right? One is to talk about what's going on in financial markets, right? As a summary measure, in order to communicate simply, the movements in large numbers of financial variables and what they imply for the economy. It's also the case, right, that quite a few of these indexes are available on Bloomberg or what have you. I would say that the academic side of the literature is smaller, and I'm going to try to elicit some lessons for academic research, by pursuing an approach very similar to that in this policy relevant research. stepping back and thinking about, what sort of academic lessons might be learned, I think it's useful to think about, what techniques and questions have fueled the growth. I think there's really two, in my view, there are two sets. One is, a set of technical advances over the last 25 years, in the use of alternative ways to aggregate data. And in the macroeconomic context, things like principal component dynamic factor models have been very popular. Although obviously, much larger data sets and different algorithms are becoming more of a focus. I think a secondary set of questions, and part of what motivates, my interest in this topic is, policymaker and public interest in summary statistics of the impetus to economic activity from financial stress or from different financial crises. I think that's interesting in an academic context, right? Because our underlying macroeconomic models, and I'm a macroeconomist, right, are often very simple and have a few asset prices in them, right? And the real world, right, asset prices often move in ways that wouldn't be consistent with our sort of simple models. And thinking about, well, what do the common movements in the data say? What is important? And then being able to step back and say, how is that related to our models, are certainly a set of questions that interest me. And so that's the motivation. I think that motivation is pretty different from actually what goes on in the construction of financial condition indexes, which really are often a pure data exercises, right? In which the sort of underlying relationships are not, are maybe analyzed ex post and not considered ex ante. So if you look, at the data, many of the indexes share a common co-movement, but it's not exactly clear why this is the case, other than that maybe they start from the same underlying set of data. And of course, purely statistical approaches, which principal components or a dynamic factor model, depending on how one constructs the dynamic factor model, I would describe those as purely statistical. They don't really ensure any link between the underlying index and any motivating economic question. Right? They're really a way just to summarize the covariance structure of the data. And as a result, especially when researchers are using a lot of data, the sort of black box nature may disguise the important role of implicit assumptions. And it's often the case, right, that economists do default to a set of assumptions that just basically are related to previous research and don't even question those. Part of my investigation is going to question some of those implicit assumptions that people use to summarize the data. So let me preview the results. Right, so I'm going to ask 3 questions. First, can a statistical approach that disciplines the roles of many variables, that is, machine learning approaches, deliver economically meaningful insights? Right, so what I mean there, right, is the output interesting? Is it a good predictor? But what do the underlying relationships look like? So machine learning is most often about prediction, right? And thinking about economically meaningful relationships is going to require that we ask the machine the right question, that we give the machine the right task. And so the question that I ask and what I look at are very important, right? It's not just an algorithm and an output, but the question and the steps that the algorithm is going through that are of interest. Specifically, I'm going to be focusing on what the role of various implicit assumptions regarding data transformation, data inclusion, things like that, play in the results and the related insights this perspective provides about other FCIs, right? So, as I noted earlier, there are a lot of financial conditions indexes. What does this approach deliver that those do not? And then in the end, I will compare the FCI to some of the others and ask about what are the relationships in economic terms that are different in this FCI than in others that may be useful to subsequent macroeconomic research. I asked 3 questions and I see 3 answers in the analysis. So first, a machine learning approach tuned to forecast future unemployment, right? And so that's what I'm going to ask the machine to do, uncovers a set of new results related to the questions. First, various default choices regarding variable inclusion and transformation strongly shape the results. That is not especially a surprise. But given the important role of sort of default assumptions in some of these, big data macroeconomic approaches, it's important to emphasize that the default assumptions really shape what variables are chosen, and as a result, what the financial conditions index looks like. Secondarily, approaches that allow for nonlinearity really show clear signs of asymmetry in how financial conditions relate to future economic activity, which I think is important from a theoretical perspective, right? Because there are certainly a default approach in macroeconomics is to rely on linear models. And then finally, the FCI depends quite heavily on equity prices, which is not the case for the sort of standard, for example, National Financial Conditions Index from the Federal Reserve Bank of Chicago. And credit spreads really are not very important. We're going to see that because of the role of default transformations, and variable inclusion. These sets of results, are different from, but also, echo various results in the previous literature, right? So I do find that term spreads are really important for predicting future unemployment in the US. And that's, the slope of the yield curve being a good recession predictor is something that's very common in the literature. And the machine, no matter what approach is used, really likes term spreads. And I think these results have a number of implications that I'll talk about in the end, for next steps. All right. So those are sort of the questions that I'll ask and a really quick preview. What I'm going to do next is walk through some of the previous literature on construction of a financial conditions index and my approach. So first, let's talk about the previous approaches. So the previous approaches have taken a variety of views on what the purpose of a financial conditions index is. And a couple for the purpose is explicitly to measure how financial conditions affect the economic outlook. Right? So that is really clear in the approach taken by Goldman Sachs and by BlackRock. They basically, describe their conditions indexes as tools that they use to talk about their economic projections with people in markets, right? Presumably to have good stories to attract clients. The financial conditions indexes constructed by the IMF, the OECD, and the Federal Reserve Bank of Chicago have all been used in that way, although they may not especially be tuned or constructed in that way. So, right, they're used as indicators for the economic outlook, although that may not be how they are constructed. A separate literature uses financial conditions indexes to measure financial stress, and there are indexes published by the Federal Reserve Bank of Kansas City and St. Louis, for example, that pursue that approach. I think an interesting thing to note is that those approaches, very much follow the same approach in a statistical sense as, for example, the Federal Reserve Bank of Chicago's approach, really just a principal component on various financial series. And then they just talk about it differently. I do think that's important to keep in mind, because I'm going to, in the end, use machine learning to pull out various results, but I'll be telling stories, right? I'm not identifying causal mechanisms. And I think the fact that, a very similar approach, by 3 different Federal Reserve banks, is used to tell different stories is a hint of the flexibility and benefits of an unstructured approach to subsequently tell stories, but also a warning about how much we should believe those stories, right? Because again, we're not talking about causal mechanisms, and economists, including myself, right? We can tell ourselves stories that in the end are not true. So that's various purposes. And what are the approaches? I see, at least in this existing literature, 2 predominant approaches. So one is a calibration exercise. And there, Goldman Sachs, in the original version, and I remember when they were constructing this index in the late 1990s, early 2000s, because I was working at the board using our large-scale macroeconometric model. And they explicitly chose 5 financial conditions indexes and used impulse responses from the Fed's model that were published for the public to calibrate the weights on each measure of financial conditions in their financial conditions index, arguing that this is how the Fed thinks about the world. The Fed has invested a lot of resources in thinking about the relationship between financial conditions and economic activity. So we're going to use that knowledge to construct our financial conditions index. So they very much were a calibration approach, based on the Fed's modeling, at least at that time, to think about, constructing a financial conditions index for forecasting purposes. I think a more predominant approach is the sort of principal component or dynamic factor analysis approach. For example, behind Federal Reserve Bank of Chicago's National Financial Conditions Index, the IMF Index, other policy institution indexes. Thinking about the scope of various financial conditions indexes, they range from being, quite small to medium to large. And so what do I mean by that? And the Goldman Sachs index and the BlackRock indexes, they both have about 5 variables, right? So they're not really a sort of big data exercise. The IMF and Federal Reserve Bank of Kansas City indexes have, on the order of 20 variables. And then the Federal Reserve Bank of Chicago's index has about 100 variables. Right? So none of these are large in a machine learning context. This is at least how, over the past 10 years, macroeconomists have sometimes called this a big data exercise. Obviously, this is not big data in the sense of what any researcher truly focused on machine learning would think about as big data. This is small data. And I'm going to fall, within this range, between the medium and the large size, as we'll see. Okay. So what data am I going to use? Well, I'm going to, not use an especially large data set, but I am going to use one that will allow others to easily replicate everything that I do. And in particular, I'm going to start with the FRED monthly database, right? So FRED is a website maintained by the Federal Reserve Bank of St. Louis. Federal Reserve Economic Data is what FRED stands for. And the monthly database is a large monthly macro data set created by Mike McCracken and Serena Ng, which has several benefits, right? It's publicly available and updated regularly on the Federal Reserve Bank of St. Louis's website. And it is basically similar to the standard approach in the literature on macro dynamic factor models. In the US, the predominant references are a series of papers by Stock and Watson. In Europe, Forney, Reichland, and co-authors have used similar approaches. While I'm going to use this data set for replicability purposes, I'm only going to focus on the financial variables within the data set. I'm going to categorize those variables, which are, there's 130 some variables in this McCracken and Ng data set. Only a quarter of those are financial, roughly speaking. I'm going to categorize them into 5 categories: equity prices, interest rates, the slope of the yield curve, which I'm going to refer to as term spreads, credit spreads, and exchange rates, right? This is, I think, a pretty broad set of how economists would think about, financial market conditions. But obviously, if there's only, a quarter of 100 or about 25, 30 variables, right? It's just a selected smattering of variables within each of these categories. In the appendices to the slides and in the paper, right, the full sort of data being included are available. When I think about constructing a financial conditions index, I am going to tune it to forecast economic activities. I'm going to ask the machine to pick the set of financial conditions and aggregate them in a way that it thinks best forecasts unemployment. In doing so, I am going to include an additional variable in the forecasting exercise. And in particular, I'm going to include the current level of the unemployment rate. The unemployment rate, certainly in the United States, is strongly mean reverting, right? And so whether the unemployment rate is high or low is important for forecasting the future unemployment rate. There's a lot of autocorrelation and mean reversion. And for that reason, the forecasting exercise will include all of the financial variables plus the unemployment rate. And I'm going to focus on the full sample from 1962 to the present, and only in a robustness exercise consider subsamples. Okay. A number of issues with regard to the data will need to be confronted. One was with regard to inclusion, and the first decision with regard to inclusion was to focus on the FRED-MD dataset. A second set of issues relates to data transformation. The standard in the literature focuses on high frequency movements in the data, right? The standard is to say, well, is the data apparently stationary or non-stationary? And if it appears to be non-stationary, typically what's done is the data is first difference, right? So at a monthly frequency, that's a pretty high frequency change. And so that's the default data transformation. If you download the code to do replication in papers by Forney, Reichland, and others, Stock and Watson, or the default code for the McCracken-Inning data set, it basically first differences a lot of variables, focuses on a very high frequency transformation because of apparent non-stationarity in things like the level of nominal interest rates, and certainly in the levels of equity prices or the exchange rate. In addition to those sort of high frequency transformations, I'm going to consider low frequency transformations. Do that because my prior is that there's a lot of noise in the monthly change in a lot of these variables, and that we may want to be thinking about whether more persistent movements have information for future economic activity, and whether or not that selects different variables. What I'm going to do in addition is include many of the variables in the exercise twice. That will include both the high and low frequency transformations, but will also include linearly dependent sets of series. And in particular, interest rates and spreads are naturally going to be linearly dependent. The spreads are typically going to be the differences between a risky interest rate or a long-term interest rate and a short safe-term interest rate. It's problematic in many approaches to include in many standard econometric approaches to include linearly dependent variables. But in sort of machine learning or penalty regression approaches, it's not a problem, right? And it helps the data just select, do you prefer the level of interest rates or the spreads of interest rates? And what might that tell us about the data? So I'm just going to include both high and low frequency transformations of various variables. And I'm also going to include, levels and spreads of various variables and say, well, what does the data select and how's that related to choices and other financial condition indexes? In the end, again, this is between a medium and large financial conditions index, right? Nonetheless, a small machine learning exercise. I'm only going to include 34 financial predictors. And at times, quite honestly, I've hoped to include more and have never had the time to sort of go back and do that analysis. But I do think that's an important, area for additional work.
Mike, perhaps I could just ask you relay a question from the audience at this stage, because it relates to that last slide. This is a question from Jack Foston, who asks, in addition to these transformations, do you apply the same outlier removal routine they use in McCracken and Ng's paper? I guess for your purposes, leaving in the outliers is important? Question mark.
Yeah. So for my analysis, I do not imply. I do not use their outlier removal process. Now, for me, actually, that's not particular. That basically that wouldn't apply in the context for the financial variables that I choose for two reasons. One is I'm focusing on full sample analysis, so data that is available from 1962 to the present, and a couple of the more purely financial variables that might fit into those 5 categories that I laid out that may have had outliers. don't have a full sample. So I think an example there would be the VIX, so volatility. Volatility is not included. A second reason is that actually the outlier analysis in McCracken and Ng excludes a lot of variables or excludes outliers for series that some may consider financial conditions, but I don't, and in particular excludes, it would be extraordinarily relevant if I included credit or money quantities, because those are variables that do get excluded often, or where outliers are excluded. For example, around the period 2007, 2008, if you looked at movements in bank reserves, one would see something truly extraordinary, and an outlier analysis would exclude that. But that data is not in my data set. So I actually don't do anything with regard to outliers. But in part, that's because of the sort of default assumptions I make, which are really important, and it's something I'm emphasizing is really important on what data to include. And so I actually don't include data that might be subject to the outlier analysis, although I made that decision for reasons different than there not being outliers, but it's a natural question. And I did go back and look because that is important in the McCracken and Ng data set.
Thank you.
Okay. So let's look at the machine learning approaches that I use. And basically I use 3 or 2.5 approaches. So the first is, the first 2, or 1.5 are lasso and elastic net. And so these are machine learning approaches in the penalized regression class. And they should look very standard to anyone who's run an ordinary least squares regression, right? And in particular, these penalized regression approaches choose weights in the financial conditions index, or choose the coefficient beta, in order to minimize the distance between, X times beta, the constructed forecast, and the unemployment rate 12 months ahead. Minimize that squared error, the first term in the equation in the middle of the slide, plus a penalty on the size of the coefficients. And the penalty of the size of the coefficients is related to both their absolute value, right? So that's the absolute value of beta there in the second summation, or their squared value. Okay? So let's just walk through what this penalized regression approach implies, under various cases, right? If there is no penalty on the size of the coefficients, this is just least squares, right? We're minimizing the mean squared error of the unemployment rate 12 months ahead and choosing the coefficients beta to do that. If lambda is greater than 0, right, a number of cases apply. The first is lambda greater than 0 and only a weight on the squared coefficient, right? So alpha equal to 0. Right, this is sort of ridge regression, and that's just an approach that shrinks the various betas towards 0. Right? So it's very much, ridge regression has been around forever. I think one of the original papers is from the 60s, or 1970. It's very closely related to various Bayesian shrinkage techniques, right? On certain priors, one could deliver ridge regression. And it's computationally really, really simple. The 2 that I'm going to use put some weight, at least, on the absolute value of the coefficients, right? So those are the cases in which lambda is greater than 0 and alpha is greater than 0. So there is a weight on the absolute value of the coefficients. If there is only a weight on the absolute value of coefficients, that's the LASSO algorithm. And if there is a weight on both the absolute value and the squared coefficient, alpha is between 0 and 1. So what putting a weight on the absolute value does, right, is it doesn't prefer purely a small coefficient, although it does prefer a small coefficient, right? It has a strong preference for a 0 coefficient, right? So it is a variable selection algorithm rather than, as in ridge regression, a shrinkage algorithm, right? So if you're doing ridge regression, you shrink all of the coefficients to 0. If you're doing a lasso regression, there is a strong preference for the algorithm to pick certain coefficients of 0, right? Because anything right, epsilon above 0 receives a penalty in the absolute value of that epsilon, right, which does not head towards 0 as quickly as the squared value of epsilon would, right? And so that's why lasso tends to select variables or elastic net, whereas ridge regression just shrinks the coefficients. These are really common approaches. They're really familiar from an economics perspective because they look like regression and they're computationally really simple. One implication of all of these approaches as well, though, is that they are all linear, right? They're all going to be a linear combination of the variables, right? They're just x times beta. And it's not an algorithm that looks for any interactions or nonlinear relationships. I'm just going to implement this in a very standard way. Elastic net, I just consider one choice for alpha equal to 0.5. Because, you know, as you'll see, that's why I call it 1.5 approaches. Lasso and elastic net deliver essentially identical results. I'm not going to do subsample analysis in the sense of holding back data, although I do that in a robustness exercise. Right? But I do try to avoid overfitting the data by doing k-fold cross validation and looking at 500 implementations and taking the average of those parameters across those 500 implementations. For the penalty variable, that is one standard error from the minimum mean squared error value. Right? So I'm not picking the best fitting coefficients, right? I'm picking coefficients that fit well. Right? And this is a standard approach in Lasso to avoid overfitting the data. And as I said, in one robustness exercise, I do consider dropping the last 15 years of data. The second approach that I use is a random forest, and this is going to differ, right, from penalized regression algorithms use equations to predict outcomes. A random forest uses a forest to predict outcomes, and a forest consists of many decision trees. Right? So an individual decision tree, it may have, in the end, 8 branches, right? And then it only predicts 8 possible outcomes for whatever you're thinking of. But if you have hundreds of such decision trees and they're all different, right, then you essentially make those predictions continuous. Right? So random forests can be used both for sort of binary or limited decision type prediction, but also for predicting continuous variables like the unemployment rate. And here's an example of a tree to predict the unemployment rate. Right? It starts by at the trunk of the tree saying, well, I'm going to predict the unemployment rate based on whether the unemployment rate today is high or low. And depending on if the unemployment rate today is high or low, I'm going to predict that the unemployment rate in the future is high or low. I then will look at, for example, the 12-month change in an equity price index or a corporate bond spread. And depending upon the value of those corporate bond spreads, predict or equity prices, predict a high or low value of the unemployment rate, et cetera. And so then it walks through this decision tree and chooses various predictions for the unemployment rate. Random forest is an algorithm that constructs many such trees in order to make a forecast. So how do you grow a random forest? Right. So first you have to define the data and the objective function. Right. Mine is to predict the unemployment rate 12 months ahead. You then choose a training sample, right? So that's a subsample of the data. And I sort of randomly choose subsamples from the data. You then, in order to not always select the same tree, you also randomly select a subset of predictors for the algorithm to choose as either the trunk or the next branch. That you determine, that's in step 3. In step 4, you determine the variable and threshold that best define that branch. Right? And then you move to step 5, right, where you go back and pick the next branch that branches off the branch that you previously chose. And you keep on doing that until the tree is as large as you want it to be. Right? And then you do that hundreds or thousands of times to predict a forest, and you have all of your trees to predict your outcome variables. In my implementation, I'm going to have a forest of 500 trees. I'm only going to allow 8 branches per tree. Like that's not a very large tree. At each iteration, I have 34 variables, but I'm only going to allow the branch selection process to see 10 of those variables randomly selected at each point in time. And again, there's a robustness analysis that will not use the full sample, but will drop the final 15 years of data. So those are the various approaches. This is now I'm going to run through the core results, which really are pretty straightforward to see. They're presented graphically. Wonder if I could pause to see if there are any questions on the approaches, or maybe those questions will emerge most naturally when we see the results.
Yeah, I think you're good to continue. We don't have any outstanding questions just now.
All right. So let's look at the results. So the first result is that, there are cases, and in certain big data exercises, Lasso and ElasticNet could differ, right? But here is the plot of the financial conditions index from 1962 through the middle of 2020. And, Lasso and ElasticNet, it's not a consequential decision. They're very similar, and that is to be expected. What is more dissimilar, and we'll walk through, why this is the case and what this tells us about hopefully about economic relationships, but also about default choices, are the comparison of this financial conditions index constructed via LASSO and that from the Federal Reserve Bank of Chicago, the National Financial Conditions Index, which is pretty heavily used. For example, it's the index used in the sort of GDP at risk literature Tobias Adrian and other have used, in the US context. You can see that, they're strong, highly correlated, especially in the 1970s. Nonetheless, there are some important differences where the LASSO Financial Conditions Index, was tightened, right? And the tightening is an increase, a positive value, a movement upwards, to a significantly greater extent in the late 1980s and early 1990s. Around the year 2000, right? So in the late 1990s and around the year 2000, there are pretty noticeable differences in the Chicago Fed Financial Conditions Index and this LASSO Financial Conditions Index. That was also the case somewhat in 2016, although it's more muted, and it's also the case this year. And part of what we'll be interested in is why that is the case. So let's first, in order to see that, look at some of the contributions. And this is presenting a set of results via graphs. And, I know sometimes it's hard to see all of the graphs. I'll walk through them, and apologize to those of you who need to, do like I just did and move closer to your screen in order to see exactly. In each line, the black line is the financial conditions index, and the colored line is the contribution of one of the subcategories. The upper left panel shows the contribution of term spreads. And what one can see is that, during certain periods, term spreads are the whole story. And in particular, in the 1970s, term spreads really drive this constructed financial conditions index. Right? That's just telling us that term spreads are a good predictor of economic activity. And that was especially true in the first half of this sample. Notice that it's less true, for example, around the year 2000 and around the global financial crisis, 2007 through 9. Notice also that the level of interest rates, the upper right-hand graph, the various transformations of exchange rates, which include first differences and 12-month percent changes, and the levels of credit spreads, which are the difference between risky interest rates and treasury yields of similar maturity. All of those contributions are hug the zero line. They're not important. They're not selected as important contributors by LASSO or ElasticNet. The final category is equity prices, and equity prices are actually selected as being quite important. And in particular, they're quite important, around the 1990 recession, but really around the year 2000 through 2003. and around the global financial crisis, that much of what is estimated to be the shift in financial conditions is attributed to the movement in equity prices. There are, just to put those results in perspective, right, the impact of term spreads is consistent with a large previous literature, that these are really important predictors. The impact of equity prices is also consistent with macroeconomic models, certainly in the Fed's models, or in our literature review a decade ago of the monetary policy transmission mechanism, right, wealth effects and effects through Tobin's Q on investment of businesses via equity prices, were viewed as really important, in the literature. That happens solely because of the inclusion of levels or 12-month changes in equity prices. The entire weight given on equity prices in those financial conditions indexes are weights on those low frequency movements. And if I only use the default transformations of using the first difference in equity prices, or the default transformation, for example, on the dividend yield of the S&P 500 is the first difference, equity prices would never be chosen. And those are the default transformations also in principal component type analyses of the Federal Reserve Bank of Chicago, for example, which also put very little weight on equity prices, right? So the machine, by allowing low and high frequency transformations, likes equity prices, but previous literature has not chosen that because of the nature of default transformations. Let's compare the LASSO results to the random forest results. Again, they're very similar, especially during periods of tightening. Now, again, we are choosing subsamples and things like that, but this is only to avoid overfitting the model, right? This is a full sample analysis, and the objective function is the same. We're trying to forecast the unemployment rate. So the conditions indexes should look very similar. That's not an insight. That's not a result. That is sort of hardwired into what I have done. But at least it tells us the computer is pretty comfortable with how it's forecasting the unemployment rate. There is, though, one noticeable difference between the random forest approach and the LASSO approach, and that is that while the tightenings in financial conditions are very similar, the movements upward, the movements downward are not as similar. And in particular, according to the random forest approach, right, it appears that financial conditions can only get so loose. There appears to be a stark asymmetry in the relationship between these financial variables and the future unemployment rate, such that very accommodative financial conditions don't have the same effect of driving the unemployment rate down as a tightening in financial conditions has in driving the unemployment rate up. And one can see that in the red line by seeing how it just sort of flattens out and does not get as low as the linear approach. I referred to the role of low frequency transformations in LASSO, but I didn't present the coefficients. Here I present the selected variables, and basically if a variable has a very low number here, it's very close to the trunk of the tree. It's among the very best predictors of the future unemployment rate. And the 12-month change in equity prices is chosen as the best predictor, other than the level of the unemployment rate, for the future change in the unemployment rate. And all the other top 5 variables are term spread variables. If I were to look at top 10 variables, right, 2 of the other top 10 variables are, again, low frequency transformation of equity prices, and a few other term spreads also show up, right? So these really are the important variables. Right? It's equity prices and term spreads are what the machine picks. In terms of, and this is basically the end of the presentation, right? I've emphasized the importance of default transformations by saying, well, what happens via including low frequency and high frequency transformations? And when I chose low frequency and high frequency transformations, right, the variables that were chosen, particularly with respect to equity prices, are really different, and it assigns a much greater role to equity prices than if I did not include those low frequency transformations. Of course, data transformations are also super important in principal components or dynamic factor models, right? And I'm not using the default transformations in McCracken and Ng, right? I include the levels of interest rates, right? And I include interest rate spreads in addition to those levels of interest rates. If I simply, because of that, right, basically this data set that I'm using, basically a lot of interest rates. If I actually were to do what is the first principal component of that data set, right, the first principal component is the federal funds rate, which you can see here. It's a graph of that first principal component and a graph of the federal funds rate. Right? That's purely a mechanical result, right? It's because of what I included in the data, right? But it's just an illustration that these default assumptions make a lot of difference, right? And the default assumptions have already pre-processed the data in a way that delivers certain results. And so we should be very careful about relying on those results, or I think we should be careful about relying on the results. And we may want to think about algorithms that allow us to select variables in different ways, right, to complement principal components or dynamic factor analysis, and then consider other data transformations or inclusions of other variables that really will end up changing what the principal component looks like, right, but allow us to see what other types of variables might be really important in shaping financial conditions and economic activity. Okay. So for a robustness exercise, I'm going to skip it, but I drop the last 15 years of data. And basically the results are really similar. And again, equity prices stand out, but somewhat less so because equity prices are really important in 2000 and in 2008. So let me wrap up. What have I done? I've developed a financial conditions index, right, that is correlated with the future state of the business cycle. That is the objective function that I have chosen for my machine learning algorithms, which were Lasso, ElasticNet, and Random Forest, to tune the parameters to. I see 3 insights, right? So one is that what variables are included and what transformations one makes are really important for typical approaches, right? So the typical McCracken and Ng, Stock and Watson, Forney and Reichman data set really emphasizes high frequency fluctuations in lots of variables, the levels of interest rates, equity prices, exchange rates, right? And that drives the fact that the weight is often put on other variables in those approaches because they're not considering, is there a lot of noise in the 1 month change in equity prices, but a lot of signal in another measure of equity prices. Another result, right, is that allowance for nonlinear approach reveals pretty significant asymmetry, right? In one way that may not be surprising, the business cycle in the US appears pretty asymmetric. Unemployment goes much higher than it gets low. But macroeconomics also often implies nonlinear relationships, and these nonlinear links between financial conditions and economic activity may be consistent with various macroeconomic models, something to investigate further. A very prosaic approach, a very prosaic result is that equity prices and term spreads, are really important according to these algorithms as measures of financial conditions. I think the main takeaway then, if you put all of those results together, is that researchers may want to consider the flexibility allowed by machine learning approaches, as one of the tools they use for macroeconomic analysis, in a way similar to what principal components and dynamic factor models have done over the last 2 decades. Okay, so that's it for me. Sorry for talking so much. I hope it was interesting, and I'm happy to answer any questions.
Super interesting. Thank you very much. Extremely clear as well. We actually have 3 questions in the Q&A box, which I can kind of relay to you. Let me kind of encourage people also to raise their hands virtually. And if you want to ask a question directly, I can kind of allow you to do that. I'll start with a question from Andy Joseph from the Bank of England. So Andy asks, Well, he notes that starting with random forests for the class of universal function approximations is likely a good start. They're often really good. However, it is known in the ML literature that it's hard to know which model will perform best before testing. Consequently, looking at other models like different types of neural nets and support vector machines may add value, potentially leading to even better results. And he wonders what you think of that. Perhaps we'll start with that question.
No. So I think that's right. And I've done a very limited exercise. Now I do think an interesting question, but one that I have not explored is the extent to which that question about best is as central for the question that I'm asking, right? Because a lot of that, a lot of the views on what is best are related to what is the best predictor, right? What is a good model to predict future unemployment? And of course, I am using the tools to predict future unemployment, right? But you may have noticed, right, that I never presented any statistics on how good a model is at predicting unemployment, right? Rather, I focused on what predictors are selected, and does that selection of predictors make sense and tell us anything about what we're doing when we do dynamic factor analysis. And I do think there are results there that were, for example, robust across LASSO and the random forest, that we want to consider low frequency transformations. But I certainly take your point that the results, I could be using other approaches, that may be better predictors. And it would be interesting to know if they also led to the same result. I would conjecture that they might, but I haven't explored it.
Lovely. Okay, so moving to a question from Jack Foston once again. So Jack asks, why does the random forest method look like it's truncated below? You remember that chart you showed? Can you provide a bit more intuition for that?
Yeah. So I mean, I think I think it's. So I told one story, right, and that was that there is an asymmetry in the effect of financial conditions on the unemployment rate, and that the random forest is describing that. Of course, that's the story that I told. I do think it's, and I think that's related to the macroeconomic literature. I mean, I think the question is a good one though, and there may be a more mechanical reason, which should hint at some caution at interpreting the results I present, right? And that more mechanical reason is that, right, the unemployment rate has only, ever been below 4% in the U.S. A couple times since 1970, right around in 2019 and around 2000. Right. And then, it was only a little bit below 4% at some periods in the 1960s. Right. So again, the random forest is a decision tree and it's trying to pick final nodes. Right. And it sees the data and I think it kind of knows, right, never predict an unemployment rate below 3.5 because that has never happened. And so it's going to naturally have a floor in a way that, a linear approach like LASSO will not. And of course, that's a very negative reason. That's sort of mechanical. Now, it's a mechanical, it may be a mechanical reason that's sort of related to underlying facts and mechanisms that, there may be an inherent nonlinearity, but I do think it's fair to conjecture that it's a more mechanical result than the economic interpretation I'm giving it.
Lovely. Okay, two more questions in the box. So the next one is from Raghav Mathur, and he asks, this is a question I was wondering about as well. So he says, out of curiosity, in your opinion, why do you think the ML would prefer equity prices and term spreads? Do you think it might be because they reflect sentiments more holistically in financial markets? And my kind of added wrinkle to that was, did it surprise you the weight it was putting on equity market variables? That's, I guess, where your findings are quite different to the other FCIs you presented, or my understanding of them.
Yeah. So, so it didn't surprise me, because I do think, certainly at the Federal Reserve, there's a long tradition of sort of wealth effects and the equity market sort of Tobin Q relationship being embedded in our macroeconomic models and it being viewed as a very important predictor. And I do think, so my own interpretation of the results is biased by being in that environment for really a couple of decades. So I wasn't surprised, and my view is that it reflects those underlying relationships. I do think, it's plausible that, there are sort of broader, I emphasize the sort of structural economic relationships. I do the sort of indicator stories and sentiment stories are certainly plausible, and I've done nothing on here, causal. So I think it's hard to parse out those two. So I'm not surprised, and I wouldn't be. I'm not averse to it being sort of a sentiment indicator type approach, rather than sort of the causal stories that I tried to lean on. And certainly my analysis doesn't differentiate between those. I think there are also, maybe mechanical reasons again, right? That, I like to think that the results are good and are telling us something, but I always do want to understand if there are mechanical reasons. And, I've emphasized there are sort of default choices and those lead to results. Could be that my default choices contribute to the result, right? And so the unemployment rate is a highly persistent variable. And by having low frequency movements in various variables, there's always a risk maybe of picking up somewhat more spurious relationships. So I don't discount that as a possibility either, right? This is one paper, and I think it should hint or point to future directions, but I don't think it's it's not, it wasn't given to us by any tablet on any mountain. It could be wrong.
Yep. Okay, and then I think we have, if you have time for perhaps one final question, because I know you have to shoot off for a board meeting after this. I said that and another one came in, so let's see if we can get through them. So the next one is from Laurent Ferreira, who asks, what about time variation in the parameters of the models, especially during the ZLB period? Could we think of a different type of relationship between unemployment and stock prices and interest rates then?
Yeah, so I mean, I certainly think that's right. I mean, certainly in my structural macroeconomic modeling work, I do think that the effective lower bound sort of should be changing relationships across, financial series, especially across any set of interest rates, other financial variables, and then economic activity. So I think that makes sense. Really, none of the approaches that I use, are being used by me in order to sort of uncover those sort of time varying relationships. I think the results, that I jumped over on robustness hint at some of that. And in particular, you could even see it in what I presented in the full sample results, that sort of term spreads were really, really important in the first half of the sample. They really drove the movements in the full sample results in the 1970s, and then equity prices were more important in the most recent two business cycles. I think if I do a subsample analysis, and estimate parameters, excluding the most recent 15 years, it's definitely the case that equity prices get a lower weight. They're still among the 10 most important variables, but term spreads get an even larger weight and equity prices get a lower. And that could be indicative of changes in relationships. Now, that's definitely not about the ELB per se, but I mean, I think there are strong reasons to think that, and I don't consider any approaches that have time varying parameters. So, yeah.
Lovely. So do you know what? We're at 3 o'clock, and we'll send you a kind of a list of the questions afterwards, so you can ponder them. But I guess we should finish, because you did ask that we finish on time. So let me kind of thank Mike for a fascinating talk. I certainly learned a lot, and it was wonderful to have you with us. I'll just advertise our next speaker. So 2 weeks from now, we have Sebnem Kalemni Ozkan from the IMF and the University of Maryland giving a talk, a COVID talk. So that should also be fascinating. So with that, let me close today's seminar, and thank you one more time, Mike.
Thank you very much, and I apologize for having the hard stop. I really got a lot out of it, and I'm happy to see any questions and have people emailing. Thank you so much.
Wonderful. Thanks again. Bye, everyone.